Good morning, everyone. Welcome. It is 6 a.m. Pacific time, November 21st, Tuesday, half an hour before the market's going to open. Yesterday, we talked about how the it seems like the bond market is pricing in Fed rate cuts, which to me personally seem crazy. I got an interesting phone call from two different traders who apparently have been watching my videos. I didn't know that, but very very well respected, many years in the markets, and they were both telling me their opinions about what is happening in the bond market. So that was really interesting. I'll share some of that with you guys. And then we also wanted to be very careful today because we have the FOMC minutes coming up. We have NVIDIA sharing earnings after the market today. And so I suggested that we might start hedging or balancing our portfolios a little bit. At the same time, we're at very high levels, overbought levels technically. So it's good to be hedged anyways. So we'll take a look at all of that after we take a look at the futures markets and see how we're opening up. So we're here in the futures markets. We can see that we are down. We are down, and let's see how significant that is. That's about 20 basis points. That's about also about 20 basis points, so a little less than that. And then here we've got about a third. So it is, normally we call this random, but it is pushing towards somewhat significant. So that's really interesting. So I want to see in the minutes or in the minute charts how this is developed. Are we trending downwards? Has it been like this all morning? Are we trending upwards? Like, did we go even lower and then we're trending upwards? Because this is the first time we've opened up in quite some time with negative numbers, like almost significant negative numbers. So let's go over here and look at the S&P minute chart. And we see that in the nighttime session, we traded up a little bit, but in the morning, we started going sideways and then coming down. And in the last hour or so, we've just been coming down. So there does seem to be a negative bias into the open. And that is going to be interesting because if we start going negative and we start developing a red bar here, that could be the beginning of a pullback. Although right now it's too early to say, it could just be chopping sideways, but we should be prepared in case we have that pullback. Now, medium to long term, actually beyond 1 or 2 weeks, we still want to be net long. So we don't want to pull our entire portfolio down or pull it into the negative side. What we want to do is short-term hedge, short-term balance our portfolio, and I'll show you what that would look like. And that's about it in futures. We have the FOMC minutes coming up at 2 p.m. Eastern. That's 11 a.m. So normally the pattern that we've seen over the last couple of years is that we'll have our normal open. So the first hour we'll have our normal volatility and volume. And then we may or may not go a little bit directional after that. And then about an hour before the FOMC minutes, it tends to flatten and go quiet. No one wants to trade ahead of the FOMC minutes. And once those minutes get released, we pretty much instantly, because we have computers and AI these days that can analyze that announcement and give us a summary very quickly. So within a minute, we start to see volatility happening right when the FOMC minutes get released. And that volatility may develop directionality depending on what those minutes say. So this is going to be really critical here. And if we do any hedging in our portfolio, we would want to do it before the FOMC minutes get released. A good time may be in that 1 hour before the FOMC minutes, where we have relatively quiet time period. So we don't have to worry about directionality of our hedge. So that's going to be my plan today is from about 10 to 11 a.m. I'm going to be looking to balance and hedge my portfolio in the short term. And if you want to day trade, then we can do that in the morning, in the first hour when there's a lot of volatility, or all the way up until 10 a.m. You can look for directionality. It looks like we are getting some. Tesla is sloped down in that last 1 hour. NVIDIA has been down all morning, pretty much parabolically. You see how curved that is? It's like perfect parabolic curve. So that's interesting coming ahead of NVIDIA earnings, especially since NVIDIA has been nothing but up all this time. So looks like at least in the early morning, we'll know a lot more in the last hour of trading. But in the morning, it looks like we're taking NVIDIA down a little bit in anticipation that maybe they won't do as well as is anticipated, because this run up this year from the beginning of this year, or even if you want to go pull back all the way to October of last year, this is a crazy valuation right here. If I remember correctly from looking at the reports of the shares and the values per share, this increase from 140 or 150 all the way to 500, that's like 300-400% growth. That represents about a $240 billion increase in the value of NVIDIA as a company. And that's just based on projected earnings. So if we don't continue that upward projection, there is room for a serious pullback in NVIDIA, which would, of course, impact the entire semiconductor industry. And this week, with light volume and the holiday week, that could pull the S&P down quite significantly, because it is one of the Magnificent Seven. The Magnificent Seven, if we remove the Magnificent Seven, the S&P, if we go over here during the year, you can see that we are up about 23%. And from the lows right here, we're up 32%. So from this period right here, if we removed all the Magnificent Seven, the S&P 500 would only be up about 5%. We'd only be right here. So 7 stocks are responsible from movement from about this 360 level all the way up to this 454 level. And NVIDIA, even if it was only exactly 1/7 of those 7 stocks, then we're talking about 8 or 9% of movement in the S&P 500. Or no, maybe not that much. What we're talking about. This was 32 minus 5, 27 divided by 7. So about 4% of this move in the S&P 500 just by itself. NVIDIA, I'm pretty sure, is the lion's share, though, because of the AI movement. So let's just call it 5%. If NVIDIA was responsible for 5% of this move, then you can see that a slip up in NVIDIA, if it starts coming down pretty hard, or if it gaps down, then the S&P 500 would gap down also, especially with the thin volume this week. So we want to be careful of that. We want to make sure we're hedged. Before I take a look at those hedges, I just want to take a quick look at TLT. So interestingly enough, both of these traders, they were telling me, Kane, TLT is going up. One was a very fundamental guy, and one is a very technical guy. And he's like, look at this power, look at how we're trading. And we've come down so hard. Or in other words, interest rates have been raised faster than they have ever been in history. And we're talking about not just a couple dozen years of history. We're talking about not even hundreds of years of history. The fundamental guy was telling me how we're talking about thousands of years of history, because it's interesting that we actually have historical records of interest rates, or we can deduce interest rates based on historical records for a few thousand years, which I thought was really interesting. I had no idea. And he was telling me, "Oh, we have these records and all this, and interest rates have never increased like this ever in history. It's unprecedented, and we know that when markets go extreme, there's always a pullback." I was actually talking about that yesterday as well, and so he was saying we are at extremes. So interest rates went up super high. This is an unprecedented drop in 10-year bond, or the long bonds over here. You see that that is a 50% drop. If you looked at interest rates, if you flip it around and you look at interest rates, he was telling me how it was like 1,000% growth in interest rates in just this 2 years. Okay. So technically and fundamentally, what they were telling me is that it's time for interest rates, or sorry, it's time for bond prices to go up. And they told me that is why there's this belief that interest rates are going to go down. And that's true. However, that's not what I was talking about yesterday. They kind of missed the boat on what I was saying. And I was saying that this Fed Watch tool is the probabilities of a FOMC rate move, not a move in interest rates. It is the probability of the Fed moving its target rate. So if the economy starts going down, or if we need some sort of stimulus in the economy, and the TLT moves and the market moves interest rates, the Fed doesn't have to do anything because interest rates are already being corrected on its own. And so the Fed doesn't have to take action. It can just let the market move the way it's going to move. The Fed will introduce an artificial force into the market if they believe that the market is not doing a good enough job, or if they believe that it'll be too painful to allow the market to clear everything up. So, for example, in the 2008 crisis, the Fed started stimulating like crazy to get our economy going. But there was a couple countries, I believe it was Iceland or the Netherlands, or maybe both, where they said, let the market take care of it. We're going to take our medicine. We were crazy with our credit ratings, and with our valuations of bonds. We made a bunch of bad loans. Let them default. Let's go through this pain, and that'll make our economy a lot stronger later. So they were willing to go through this economic downturn and a worse recession than the United States saw. The United States came out of it relatively quickly, and we saw our markets go up higher. But fundamentally now, if you look at those economies, they're a lot stronger. Whereas we keep needing the Fed to prop us up and prop us more and more and more. And yesterday we talked about how if we remove that artificial stimulus, then that's going to be a harder crash for that market. And eventually the Fed is not going to be able to stimulate. It's sort of like a drug. The first hit, it has a huge effect, but each subsequent hit gets worn out. It doesn't have the same effect that it used to. So that's what I was talking about. I was talking about it's crazy to me to think that the Fed is going to move its target rate. It's ridiculous to me to think so. And it's not ridiculous to me to think that interest rates will move and continue to lower on their own. And that's normal market movement. We want to be careful and discern. So how much of this movement upwards is a natural market movement, natural forces within the market, and how much of it is artificial stimulus by governments? And right now, we are pricing in artificial move in by governments to stimulate the economy, which I don't think we have any data to support whatsoever that that is going to happen. So TLT may go up, but short term, I don't believe that, unless we're talking multi years, that in the medium term that we should be moving extremely high. So if I go to a weekly chart in TLT, do I believe that we could go up and touch this MA50? Absolutely. Do I think we're going to go screaming higher to this MA200? Absolutely not. Okay, at least not in the short term, in the next 3 to 6 months. And these Fed Watch tool right here, this out to May, that's 6 months, and we're having a 12-13% probability of a 50 basis point rate cut. And that to me is ridiculous. So we want to discern exactly what we're talking about, and this price movement, how much of this price movement will be explained by natural forces and how much of it will be explained by outside artificial stimulus. I want to clarify that point for everyone. So now let's take a look, because we are getting closer to the open, on how we might start to hedge our portfolio. So if we're long, or if we want to keep our portfolio long in the medium term, so to take advantage of this change in trend. So right now on the medium term, we changed trend from this medium term downtrend. We have now crossed above and now have turned into a medium term uptrend. And actually these lines that we drew are actually really good. I don't think we drew them for this purpose, but we can see that this was the downtrend. We have a break and then a short consolidation period, and then we can see that this is now the new uptrend on the medium term. So we will expect that this medium term uptrend will hold at least through the end of this year. So for the next month, which is not that much longer on this time scale, but it looks like that we will continue this probably for at least another 6 to 12 months. Unless something breaks and we have some weird news or weird things happening in the economy, it might break again. But for now, this is what it's looking like. So on a 1 month, 2 month, 3 month, 6 month, 12-month scale, we want to be net long if your portfolio is constructed that way. Most of my portfolios are constructed shorter term, 1 month to 3 months maximum. So on a 1 month or 3 month scale, I still want to be long in my portfolio. I want to follow this trend. I just want to be prepared for a pullback to this blue line that we just drew, or pull back to this sea green line that we've talked about a lot. So how would we do that? Well, that just means that in the next 1 to 2 weeks, I want to be hedged. I can keep my longs. So I would have short dated 1 to 2 week expiration options that are net short, and that would balance my portfolio out for the next 2 weeks. The easiest way to do it, well, I don't want to show you the easiest way because I've showed you a couple of times how to do it, beta weighting. So I don't want to do the exact same thing over and over again. Let's learn something new. So here's and I'm going to have to do this pretty quickly, probably in the next 5 minutes, so we all have time to get ready for the market open. I will not. Interesting. I'm going to reload this. There we go. Okay. So where do we believe that we can pull back to? Well, what's really interesting now is that EMA 20 is at pretty much the exact same level as the sea green line. So the area where we broke out from. So if we pull back, it's going to an EMA 8 pullback at this point would be kind of meaningless. It's not very much. So most likely we're going to fill this gap, or we're going to come down to that EMA 20, which is the exact same level as this C green line. So let's just say it's EMA 8. The EMA 8 is currently at 446.75. So the belief is that when we pull back, we're going to pull back at least to the 447 level or lower. So I want to benefit if it goes down to 447 or lower, which means I could just buy a put, but that would be the same as we showed you before, beta weighting, just buy a put, very simple. If we believe that we're going to go down to 447 though, because the EMA 8 is even lower than 447, then there's some interesting things that we can do. We can do some spreads. And the great thing about spreads is we have the potential of some really great reward risk ratios. So let's see if we can find, let's go over to the option strat. And I'm going to build a bear put spread on SPY and 447, right? So 447 is, I believe that it's going to fall at least to 447 because 447 is still above the EMA 8, and we believe that we're going to fall at least to EMA 8, maybe all the way to the EMA 20. So what happens if I start building a spread like this? Okay. So what happens here is if we don't get that pullback, let's go December 1st. Oh yeah, that's even better. So remember, we only want the short term. We only want to be hedged short term for 1 or 2 weeks. December 1st gives us just under 2 weeks, 10 days. And if we do fall, and we fall at least to 447, okay, so, or just say at least to 448.66, we're going to start making some money. So that protects our portfolio against a drop. And what's really great is if we never go low, we just keep on going higher, what am I losing? I'm losing $34 if I do one of these spreads. But if we fall at least to 447, and our belief is that we'll go at least to the EMA 8, which is 446.75, you can see we stand to make a bunch of money. We stand to make what 100 is at 34 loss. So that is a 166 profit versus $34 loss. That's crazy. That's 480%. So this is really great. It's almost a 5-to-1 reward risk ratio. So I have very little risk and I have a lot of reward potential, and anything below 447, which is right here, right above our EMA 8, if we fall to here or below, then we make that full entire profit. So this would be really great to add in to our portfolio. So if we're wrong, we just lose a little bit of money. And if we're right, over the next couple of weeks, we make a whole bunch of money, and that would offset any losses towards our long portfolio. So if we're wrong, our longs continue to make money, and they should far outshadow this $34 that I stand to lose. But if we're right and we get that pullback, the money that I lose from my long portfolio is offset by this 166. How much it's offset is completely up to us. It depends on how many of these I buy. Do I want to hedge against all losses, or do I want to hedge against partial losses? It just depends on how much I believe in that pullback. And the way that I would do that is, again, we go back to beta weighting, and we can see that the delta here is $6. So if I want to hedge completely and my current portfolio is beta weighted delta is at 60, then I would buy 10 of these. It would cost me $340, and in the event of a pullback, I'm completely protected. On average, I should lose very little, or in theory, zero, but on average, it would be very little, or I might even stand to make a tiny bit of money because it's not 100% perfect. So consider something like this. You don't have, doesn't have to be 449, 447. It could be, if you believe that we can pull back to the EMA 20, then you could say, hey, we'll pull back at least to 449, and that EMA 20 is at 438.84, so we'll go to 439. Okay, so at any point, if we drop at least to 448, if we drop at least to 448, we'll start making money. And now, if we make that move, I stand to make a whole bunch of money versus at $92 versus my 908. So that's almost a 10-to-1 reward risk ratio, assuming we hit the maximum. But if we try to capture this entire range the way I've spread it, we may stop partway between, and maybe we'll only make $600, but still that goes a long way towards hedging the losses. We might actually make money if we spread it this way. So it's up to you. Play around a little bit with these spreads and decide how you want to hedge your portfolio in the short term. That way you can keep your longs and still profit in the long term, and keep your view that the medium term we're going up in the overall markets. Okay, that's it for today. We have less than 4 minutes to the market, so a little bit longer today in the pre-market. But hopefully you're learning a lot, and maybe you'll take some action around 10 a.m. Pacific to get your portfolio hedged. I'll see you in the afternoon session.